Hello and welcome to this session on fixed income instruments. In this session, you will learn about Public Provident Fund, National Savings Certificate, deposit products, fixed income mutual funds, and fixed maturity plans. Fixed income securities can be classified according to the issuing party. This classification is a good way to understand the features and nuances of the different types of fixed income securities. Fixed income securities can be issued either by the government or by the corporates. Government issued fixed income securities are subdivided into Public Provident Fund, National Savings Certificate, and government bonds. Corporate issued fixed income securities can be subdivided into deposits, mutual funds, fixed maturity plans, and corporate bonds. We will cover all the types of fixed income securities in this session except for government and corporate bonds, which will be covered in the next session. Let us begin with Public Provident Fund. What is the Public Provident Fund scheme? PPF stands for Public Provident Fund. It is a scheme by the central government framed under the PPF Act of 1968. Tax saving as an important consideration for any earning individual, and as a part of that, one of the famous tax saving tool is the investment in PPF. Thus, we can say PPF is a government backed long-term small savings scheme which was initially started by the government to provide retirement security to self-employed individuals and workers in the unorganized sector. However, at present, it is considered as the best tax saving scheme across all sections of the population. With this, let's understand who can open a PPF account and who cannot. In other words, what is the eligibility criteria for PPF accounts? Only one PPF account can be maintained by an individual except an account that is opened on behalf of a minor. Non-resident Indians are not eligible to open an account. However, a resident who becomes an NRI during the tenure prescribed under the PPF can have an active PPF account. A PPF account can also be opened by either parent under the name of a minor. However, each person is eligible for only one account under his or her name. The mother and father both cannot open PPF accounts on the behalf of the same minor. Thus, in case a couple has two children, they can maximum open 4 accounts, that is 2 in their own accounts and 2 in the names of their children under guardianship or either or of as a parent. Whereas for the NRI account, schemes may continue to subscribe to the fund until its maturity and a non-repatriation basis. However, such an account will not be eligible for extension of 5 years at the time of maturity. Moving on to the benefits of PPF. The interest earned on PPF accounts, that is on the full balance in your PPF account, is completely exempted from tax. In other words, your returns on investment in PPF are tax-free. Deposits up to 1,50,000 per annum into your PPF account are deductible under Section 80C of the Income Tax Act. Contributions to PPF accounts of the spouse and or children are also eligible for tax deduction. Above all, the balance in the PPF account cannot be attached to any claim in case of debt or liability. Thus, the money is yours for life, and even after death, the same is available for your family. Next, we see the return on investments for PPF. So the PPF return on investment has been around 8.5% or so, but on the higher side of that. You can understand that investment in PPF has a compounding effect, and the individual who has made an investment will earn interest based on the rate of interest. For example, As per the new budget 2015, the new investment in PPF account is 1,50,000 and max investment in PPF, for example, for 15 year will be around 22,50,000. The total money earned from PPF account will with interest will be that of 46,75,910. Now let's understand National Savings Certificate. The National Savings Certificate or NSC is a certificate issued by post offices in India. It is considered excellent small savings scheme. If an investment is planned, it can be used as a pension scheme post retirement since the NSC offers monthly withdrawal plan. There are schemes specially designed for government employees, businessmen and other salaried classes. We have seen what is NSC. Now let us dive into the benefits of NSC. NSC has multiple benefits and the most important of all is that it is a tax saving instrument and an amount of up to 1.5 lakh can be claimed under ATC. NSCs are available for 5 and 10 year periods. They are also available for a minimum of rupees 500 and in multiples of 500s, thousands, 5,000s and 10,000. There is no maximum investment limit for a NSC. The types of NSCs are as follows. First is single holder type of NSC, which is issued to the holder himself on behalf of the minor. The second type is joint A type certificate that is issued jointly to two adults payable to both the holders jointly. And lastly, joint B type certificate which is issued jointly to two adults payable to either of the holders. After studying the types of NSCs, now let us see the return on investment of NSC. The interest rates are 8.5% per annum for 5 years and 8.8% per annum for 10 years. The interest has compounding effect which is calculated half yearly. An investment of rupees 100 made in a 10-year NSC will become 232 after the tenure. So basically it will give you approximately 134% return after 10 years, which can be used as an excellent tool to plan for your post retirement. Moving on to deposit products. To simplify it, banks accept deposits from people with surplus funds and lend it to people who are in need of funds. The deposit products are governed by the Banking Regulation Act of 1949. Banks fulfill a social function. They encourage and facilitate savings by the general public and ensure that financial well-being. About 80% of the bank's resources are contributed by deposits. The RBI is empowered to regulate the workings of the products and banks are free to work within the broad guidelines provided by the RBI. So why should a depositor come to a bank? Banks are preferred over other financial institutions because they fulfill the expectations of depositors across various criteria. Firstly, we have safety. Banks are considered to be the safest and most trustworthy institutions. This belief attracts depositors at relatively cheaper rates. Secondly, depositors are looking for liquidity. Banks have large resources and are able to allow withdrawals even on fixed deposits. Next, we see returns. Return is a function of safety and liquidity. Higher the level of safety and liquidity, lower is the return and vice versa. Last but not the least is credibility. Banks are regulated by the Reserve Bank of India, which lends credibility. Deposits can be classified under two broad categories: term deposits and demand deposits. Term deposits are a type of deposit with a fixed term. They are short-term deposits with maturities ranging anywhere from a month or to few years. Demand deposits are funds in an account from which the deposited funds can be withdrawn anytime without any advance notice to the depository institution. Demand deposits can be demanded by the account holder at any given time. So for example, if you see, savings account and current accounts are an example of demand deposits. Now we will move on to term deposits in detail. Term deposits are deposits that are received for a fixed time or period. Deposits are accepted for a period ranging from a minimum of 7 days to a maximum of 120 months or 10 years. Term deposits are withdrawable only after the expiry of the fixed period. The interest varies as per the period for which the deposit is contracted. Term deposits attracts penalty if the deposit is withdrawn prematurely. There are three types of term deposits: fixed deposits, cumulative deposits, and recurring deposits. Let's take a look at the types of term deposits in detail. First is fixed deposit funds. Fixed deposit funds are repayable on expiry of the time period agreed upon, and interest is paid at periodic intervals. Next is cumulative term deposits. Cumulative term deposits are fixed deposits with a compounding of interest at quarterly intervals. Lastly, we come to recurring deposit funds. These funds are deposited at regular intervals and earn the interest of fixed deposits. Premature withdrawal of term deposits is possible, however, banks can charge a penalty. Let's take a look at an example. A customer deposits 10 lakhs for a period of 5 years at a rate of 10% per annum. But he decides to withdraw the amount prematurely after 1 year of depositing it. If interest rate on the date of deposit for 1 year was 8%, the interest is calculated on the deposit at 8% and not 10%. Banks can also levy a penalty for premature withdrawal. Next, let us focus on regulations of term deposit products. Banks should issue term deposit receipts. Disposal instructions of deposits should be obtained in the application form. Term deposits should be freely transferable from one office of the bank to another. Term deposits gives the facility to withdraw the term deposit before the maturity date. The bank will notify the customer of the impending due date of maturity. Finally, the penalty rate should be made known to the customers. Moving forward, let us study fixed income mutual funds. A mutual fund is a vehicle to mobilize money from investors to invest in different markets and securities in line with the investment objectives agreed upon between the mutual fund and the investors. In other words, through investment in a mutual fund, a small investor can avail of professional fund management services offered by an asset management company. Mutual funds play a critical role. The primary role is to assist investors in earning an income or building their wealth by participating in opportunities available in various securities and markets. The mutual fund structure, through its various schemes, make it possible to tap a large corpus of money from diverse investors. The money that is raised from investors ultimately benefits governments, companies, or other entities directly or indirectly to raise money to invest in various projects or pay various expenses. The mutual funds can keep a check on the operations of the investee company and their corporate governance and ethical standards. Higher employment income and output in the economy boost revenue collected of government through taxes and other means. This promotes further economic development and nation building. They can also act as a market stabilizer in countering large inflows or outflows from foreign investors. Mutual funds are therefore viewed as a key participant in the capital market of any economy. Moving to the types of mutual funds. The first type is Open-ended funds. Although some unit holders may exit from the scheme wholly or partly, the scheme continues operations with the remaining investors. The scheme does not have any kind of time frame in which it should be closed. The ongoing entry and exit of investors implies that the unit capital in an open-ended scheme would keep changing on a regular basis. Next are interval funds. The benefit for investors is that unlike in a purely closed-ended scheme, they are not completely dependent on the stock exchange to be able to buy or sell units of the interval fund. Minimum duration of an interval period in an interval scheme is 15 days. Till then units have to be compulsorily listed on stock exchanges to allow investors an exit route. Lastly, we have closed-ended funds. Closed-ended funds, after the NFO, investors will have to transact only through exchange. Since post NFO, the sales and purchase of units happen to or from the counterparty in a stock exchange and not to and from the mutual fund, the unit capital of the scheme remains stable or fixed. Moving ahead, let us understand how mutual fund schemes operate. Let us start with mutual fund scheme announcements. Mutual fund schemes announce their investment objective and seek investments from the public. The investment that an investor makes in a scheme is translated into a certain number of units in the scheme. Thus, an investor in a scheme is issued units of the scheme. Next comes the NFO or the new fund offer. When a scheme is first made available for investment, it is called as a new fund offer. During the NFO, investors may have the chance to buy the units at their face value. Post NFO, when they buy into a scheme, they need to pay the price that is linked to its NAV. Finally, you have assets under management. The relative size of mutual fund companies is assessed by their assets under management or AUM. When a scheme is first launched, AUM would be the amount mobilized from investors. Further, if the scheme is open to recovering money from investors even post NFO, then such contributions from investors boost the AUM. Conversely, if the scheme pays any money to investors either as a dividend or as a consideration for buying back the units of the investors, the AUM will fall. The AUM thus captures the impact of the profitability metric and the flow of unit holder money to or from the scheme. Mutual funds have many advantages for investors. The first advantage is professional management. Remember that in a mutual fund, you are the one who's depositing the money to purchase the units. Once the units are purchased, the money is being managed by the professional fund manager. He is the one who's selecting the right stocks. He is the one who's selecting the right sectors. And in a way, you are actually giving your money to a professional fund manager. So that is where professionalism comes in. The next is affordable portfolio diversification. Understand that when you invest in a mutual fund, the fund manager is investing your money into multiple instruments. He would be buying shares of Reliance and HDFC Bank and Infosys and Axis Bank. So he would be buying multiple securities with the funds that you've invested in the mutual fund. Now this gives the benefit of diversification. Understand that there could be something wrong going on with Infosys, but at the same time there would be something good going on with Axis Bank and Reliance. So in a way, the good things and the bad things will counter each other, and that is how diversification benefits an investor. Thirdly, there is liquidity. Now when I say liquidity, what this means is it's easy for any investor to withdraw or invest additional money into the mutual funds. Especially with open-ended mutual funds, you can redeem or subscribe for more units anytime. Lastly, there is tax benefits. There is a special class of mutual funds called as ELSS or equity linked saving schemes. ELSS comes under ATC. Investments up to 1,50,000 can be claimed for tax exemption when you invest in a ELSS. Now, ELSS funds invests your money in equity instruments. Most of them are focused on large cap or mid cap companies. So, let us compare mutual funds with term deposits. In the event that a bank fails, the deposit insurance scheme of the government comes to rescue of small depositors up to 1 lakh per depositor in a bank across branches. And this will be paid to the investor. Mutual fund schemes do not offer any such insurance. The depositor can also prematurely close the deposit at any time with penalty in order to meet liquidity requirements. This is there in mutual funds too. In a mutual fund scheme, no return is guaranteed. However, it is possible to earn returns that are much higher than in a bank deposit. With a bank deposit, the depositor can never earn a return higher than the interest rate promised. Moving ahead, you will now learn about fixed maturity plans. While banks and companies can tell investors what they will pay, mutual funds cannot declare the yield on closed-ended debt schemes. They were earlier barred from disclosing the indicative portfolio of these schemes. However, last year, the Securities and Exchange Board of India allowed closed-ended debt schemes to disclose instruments in which they propose to invest, as well as floors and ceilings within 5% range of the intended allocation. The aim was to help investors arrive at the return they could expect from these closed-ended funds. Fixed maturity plans are closed-ended fixed maturity schemes that invest in debt securities such as T-bills, commercial papers, certificate of deposits, and government and corporate bonds. An FMP's offer documents should mention the instruments in which the scheme plans to invest in, the proportion each instrument will account for, along with the credit quality and yields. Take a 3-month FMP which was open for sale on 19th and 20th March 2012. The offer document gave the following disclosures. The scheme's tenure is 91 days. Closed-ended debt funds cannot invest in securities with maturity period of more than the scheme's tenure. Finally, let us compare the various fixed income instruments on certain key parameters like return on investment and taxability. As you can see on the screen, mutual funds offer the highest ROI at 16% while bonds offer the lowest at around 8%. Though these instruments act as good investing schemes, it is completely dependent on the choice that a trader or investor based on his risk and return preferences. With this, we reach the end of this session. Thank you and goodbye.